while gold rallies as a safe haven when real rates fall in downturns. U.S. stocks have rebounded from near bear market levels following President Donald Trump's Liberation Day tariff announcement on April 2nd, and the S&P 500 and NASDAQ composite hitting several new highs in September, a historically weak month for equities.
What's worse is their reaction to the market trying to correct and overwhelm their manipulations is going to be more manipulation, just setting us up for something worse the next time around.
MarioInnecco, market analyst, views gold's rise as the outcome of decades of financial excess finally reaching a breaking point. He notes that governments worldwide have relied on cheap debt and relentless stimulus to prop up fragile economies, creating a system dependent on constant intervention. This cycle of borrowing and printing may have delayed collapse, but it has also quietly undermined confidence in fiat currencies. Innecco argues that gold's latest surge is not a speculative move, but a reflection of this deeper loss of trust, a recognition that the rules holding the financial system together are fraying. Gold, in his words, is not reacting to the noise of headlines, but to structural flaws that have been ignored for too long. He stresses that inflation is at the heart of this story, even when official data suggests moderation. Families still feel the pinch in their grocery bills, rent payments, and utility costs, which continue to rise faster than wages. This erosion of purchasing power is what drives ordinary people, not just large investors, to seek protection in tangible assets. Gold offers what paper currencies cannot: permanence and independence from political manipulation. Innecco further points out that geopolitical fractures, whether in trade relations, sanctions, or shifting alliances, are amplifying the appeal of gold as a safe haven. In a world increasingly shaped by uncertainty, tangible wealth becomes more valuable than promises on paper. Looking to the future, Innecco believes the path for gold could be transformative. Central banks are trapped in a dangerous balancing act: tighten too hard, and they risk triggering a credit crisis; loosen too much, and inflation surges further out of control. Either outcome supports gold, leaving it as one of the few assets that can thrive across scenarios of instability. He sees this not as the peak of gold's journey, but the early stages of a major revaluation that could redefine its role in the global financial order. For long-term investors, Innecco warns that ignoring this shift would mean missing one of the most important monetary realignments of our time. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates, and enjoy the video.
Gold is now the anti-fragile asset to own rather than treasuries. High-quality equities in gold are the best hedges, Wilson told Reuters Global Markets Forum. The strength of a dual hedge lies in the contrast. Both hedge inflation, but equities are growth-linked, risk-on bets, while gold rallies as a safe haven when real rates fall in downturns. U.S. stocks have rebounded from near bear market levels following President Donald Trump's Liberation Day tariff announcement on April 2nd, and the S&P 500 and NASDAQ composite hitting several new highs in September, a historically weak month for equities. Spot gold prices, meanwhile, surged past $3,700 an ounce to a record high on Tuesday, buoyed by mounting expectations of a rate cut by the Federal Reserve this week. The lows in April will prove to be great for many stocks. The moves we've seen since then in some of the most beaten down areas have already been remarkable, Wilson said. Alpha is making a comeback since Liberation Day, he added. Alpha is the excess return over a benchmark to describe an investment strategy's ability to beat the market. Meanwhile, fund managers warn that treasuries are losing some appeal as skepticism over the Fed's independence is beginning to weigh on long-end yields. So it's not just Morgan Stanley warming to gold, it's also the bond king, Jeffrey Gundlach. And recently he spoke, and this is what he said: go overweight gold. Well, and this is a bond guy, and I quote him: I still think gold serves a purpose in portfolios, he said, suggesting allocations as high as 25% of a portfolio may not be excessive. He framed such positioning as an insurance policy rather than a speculative bet, and one that could see even more upside if macro trends hold. He even floated the possibility of gold surpassing $4,000 an ounce by year end, a level that would mark a seismic move in the metals market. For RIAs, the key takeaway is to re-examine client exposure to commodities and gold-related instruments, whether through direct bullion holdings, ETFs, or gold miner equities. So there you go. Yeah, this is huge. The investment managers are going to start looking into gold. They're going to be saying, how come we don't have any gold? And clients, are going to be calling them and saying, how come we're not exposed to gold? And that's why 20 times the gold price from today is not impossible. I'm not saying it's going to happen tomorrow or even next year, but over the next few years, I don't think it's out of the realms of of possibility. Back in the 70s, gold went from 35 to almost 900. That's more than 20-fold. And that was an era where bonds were out of favor. And it looks like bonds are becoming more and more out of favor, even with the bond king and Morgan Stanley. So let's quickly look at where the markets are this morning. It's 7:38 a.m. London time. Spot gold is at 36.46. It's only up a couple of dollars. Earlier this morning, I checked out the markets and it was about $10 higher. So it's moving around. Here's just noise. But the technical picture for gold, silver, and the miners still looks pretty good to me. And, well, for some of us, it seems like this bull market has been going for a long time. But for the general public, for Wall Street, I think we could be still in the early innings. So just hold on tight. Be right and sit tight, as Jesse Livermore once said. Spot silver is up 30 cents, almost up 1% at 42.12. High's been 40. Low's been 41.63. The stock market, the Dow futures is down 20. The NASDAQ is unchanged virtually, and so is the S&P. Everything's fairly quiet. The currencies as well are fairly quiet, with the exception of the British pound, which is down about a third of a percent. And not surprising with the bad news about the budget deficit. And it looks like the Bank of England isn't helping out. They didn't cut rates yesterday because our inflation rate, or CPI, that they call inflation CPI, which is wrong, is running at 3.8%. But it's more like 4.8. And I think the Bank of England knows that because they conspired, in my opinion, that's speculation, with the ONS and the government back in 2022 to fudge the CPI numbers. You can watch this video I did here back in 2022. So yeah, what I'm saying is CPI is more like 5%, and the Bank of England knows it. Yeah, the pound, I think, is a little bit like Wile E. Coyote right now. It's looking down, and it's going to drop very quickly soon, in my opinion.
MikeMaloney expands on this perspective, noting that the current gold rally cannot be separated from the broader cycle of fiat currency decline. He explains that every paper-based monetary system in history has eventually failed, and today's dollar-dominated system is no different. With trillions in unfunded liabilities and growing global skepticism about U.S. fiscal discipline, confidence in fiat money is deteriorating. In this climate, gold becomes not just an asset, but a parallel form of money that carries no counterparty risk. Maloney highlights that central banks themselves are leading the way, quietly accumulating record amounts of gold while reducing exposure to dollars and U.S. treasuries. Both Innecco and Maloney agree that the psychology of investors will play a crucial role in what comes next. As more people recognize that gold is not just a defensive asset, but a generator of real wealth preservation, demand could accelerate rapidly. Maloney warns that once confidence in fiat money slips further, gold could move explosively higher in a short period of time, catching latecomers off guard. The combination of monetary fragility, structural inflation, and eroding trust in governments creates conditions where gold's true value may finally be revealed, and in their view, that moment is drawing near.
Talking about the monetary system, if we were using something of limited quantity like gold, where it grows at about the rate of the population, maybe a little bit more, maybe a little bit less, we would experience a world where there wasn't this constant wealth redistribution from the poor and the middle class to the uber wealthy. And what you would see is that you would actually be able to hold your gold or silver or whatever we used that was of limited supply at home. And it would be a somewhat deflationary environment where your purchasing power would increase constantly. Why? Because man gets more efficient. We figure out better ways of making things, and we are constantly more productive. Everything should naturally be falling in price, not going up. This is all an illusion that we live in, caused by the Federal Reserve.
Exactly. I agree completely. And that was a huge epiphany for me when I realized that the CPI went down every year on average until 1913, creation of the Federal Reserve, and then it started going up. And then, in 1971, it started going up like a hockey stick.
Yeah.
So sound money for the win.
And Wall Street is better off for it. The wealthiest people are better off, but not the average person.
So Mike, this is a crazy setup. This is for the biggest crash in history that you've talked about for more than a decade. What do you make of all this?
Well, that is all that it adds up to. The labor market is in a recession. The Fed looks like they're going to be cutting rates. That adds up to there is an emergency right now, and we're in the greatest bubbles in history. If there's anybody watching this video that didn't watch my bubble whip video from a couple of weeks ago, please go watch it so that you understand where the economy is. We are teetering right. I talked about a knife's edge or on the edge of a cliff. And in my book, one of the, in chapter 5, you and I prove, then this was in 2022, that we were already pretty much in the biggest bubbles in history in all asset classes except gold and silver. And I keep on repeating, the higher the cliff, the bigger the fall. In order to get back to just realistic levels where the financial sector is in balance with the rest of the economy, right now, the Federal Reserve has warped the economy to unprecedented, dangerous levels. And it is 100% the Federal Reserve's fault. And so this crash, just when it comes, and it will, it isn't a matter of if, it's only a matter of when. When it comes, just realize two things, that this is Ben Bernanke's fault and the Federal Reserve's fault. It isn't the market, the free market. When they scream, oh, the free market isn't working. No, it is working. It's overwhelming the manipulation that they did, the bubbles that they caused. This is the inevitable result of their actions. And what's worse is their reaction to the market trying to correct and overwhelm their manipulations is going to be more manipulation, just setting us up for something worse the next time around.
Looking ahead, the future trajectory of gold prices seems poised for powerful moves that could redefine how markets view wealth preservation. If current inflationary pressures persist alongside mounting debt and geopolitical strains, gold could surge far beyond its past highs, driven not by speculation alone, but by necessity. Central banks continue to accumulate at record pace, while retail and institutional investors are increasingly recognizing that fiat currencies are trapped in a cycle of erosion. This convergence of demand, scarcity, and distrust in paper money sets the stage for a revaluation that could make today's levels appear modest in hindsight. Some analysts warn that as financial systems shift toward digital currencies and potential resets, gold may serve as the anchor that restores credibility to money itself. In such a scenario, the metal's role would expand beyond being just an investment hedge. It could become the backbone of stability in an uncertain new order. If these structural forces play out, the next decade may not simply be about higher prices for gold, but about its reemergence as the ultimate arbiter of value in a fragile financial world. If you found this analysis valuable, don't forget to hit the like button, subscribe to the channel, and share your thoughts in the comments below. Your engagement helps bring these critical discussions to more people who need to hear them.